Section 5 wants you to compare what is the difference if a company is leveraged with capital versus debt. So if somebody invested in a business with $100,000 of her own money versus putting in $50,000 of her own money and borrowing $50,000 from the bank. So there was an example of this in our slides as well for this chapter. Okay, so here's the given information. The first scenario here is if we invested $100,000 of her own money. It says that the company is going to earn an after-tax profit of $15,000. Okay. Now, what is our return on investment? Our return on investment, if we had a $15,000 after-tax profit on a $100,000 investment, our return on investment would be 15%. Okay, so we have a 15% return on equity if we invest that $100,000. What if we borrowed that money, half of it, from the bank? So we have to recalculate what happens if we borrowed half the money from the bank. So step one, if we borrowed money from the bank, we would have to pay interest on that loan. So the first step is to calculate the interest. So the amount borrowed was $50,000. Our interest rate, which is given in the problem, is 10%. It tells us that that is an interest rate after tax, so that we don't have to worry about the tax implication because the interest would be deductible on our return. So our interest is 10% of $50,000 or $5,000. Step two is, since we have an additional expense, we have a different after-tax profit. So we have to recalculate the after-tax profit. Our original after-tax profit was $15,000. We are going to subtract from that our interest. So our new after-tax profit is the original less the interest, or $10,000. Now, step three is calculate our new return on investment. Our after-tax profit is the $10,000 from step two. And our investment is, in this case, only the $50,000 that she put in of her own money. So her ROI is the $10,000 divided by the $50,000, or 20%. So my return on investment, even though I reduce my net tax profit by $5,000 because I have an additional expense on that interest, my return on investment is higher because less of that money came out of my pocket. Okay. Problem number 6 gives you various balances on a balance sheet and asks you to fill in the remaining accounts. So this is just like the problem that we had for homework. The best thing to do with this is to set this up in a balance sheet format. So what does our balance sheet look like? This is, the example here is ABC Corporation. So let's set it up. ABC Corporation. And this is a balance sheet. So balance sheet as of December 31st. Okay. So what comes first on our balance sheet? Our assets. Our assets include current assets. Those are the assets that we're expecting to use within the first year. We have cash, accounts receivable, and inventory. All of those together are our total current assets. Then we have fixed assets. Those assets are our investments in machinery and equipment, and those aren't expected to be used within the first year. We have the gross fixed assets, and we reduce them by accumulated depreciation. And that gets us our net fixed assets. Okay. Our total of current assets and net fixed assets are our total assets. This is what we call the left-hand side of the balance sheet. Now we have our right-hand side of the balance sheet. We start with liabilities. These are the amounts that we owe to other people. That includes our current liabilities, which are our accounts payable and our accruals. Those together equal our total current liabilities. And then we have our long-term debt. So those are the amounts that we owe to our creditors that we will pay past 1 year from now. Our current liabilities plus our long-term debt are our total liabilities. The final part of our right-hand side of the balance sheet is our equity. And that includes our common stock, a paid-in excess, and retained earnings. Those all together are our total equity, and our liabilities plus our equity are our total liabilities and equity. And remember that these two sides of the balance sheet will balance. So what does that mean? That means that our total assets will equal our total liabilities and equity together. So that is our accounting equation, and that will always be true of our financial statements. Okay. So now let's fill in the information that is given into this setup of the balance sheet. We were given that accounts payable was 70, accounts receivable was 150, accumulated depreciation was 300, fixed assets net was 950, inventory was 120, long-term debt was 390, paid in excess was 150, retained earnings was 420, and then it gave us that total assets were 1,290, and that our total liabilities were 550. So now we have to fill in the pieces that we don't have. So we can go ahead and, that actually is just a total here, and color those in yellow so that we know what we have to fill in. Okay, let's start with the easiest one, our accounting equation. We know what our total assets are. Our total assets will equal our total liabilities and equity. So we know that this has to equal our total assets, or 1,290. Okay. We know that this total liabilities and equity is the total of our liabilities plus our equity. It told us what our total liabilities are in the problem. So we can get from that our total equity. And we use our total liabilities and equity less our total liabilities to get the piece of it that's equity. So that's 740. Now we have all the pieces except for one that go into total equity. So if we take our total equity less the other pieces, our paid in excess, and our retained earnings, we can get our common stock. Because these three things added together should be our total equity. We also can figure out our total current liabilities, because our total current liabilities plus our long-term debt is going to equal our total liabilities. So we can subtract, take our total liabilities less our long-term debt to get the amount of our total liabilities that are current. And so that is 160. We now have all the pieces except for one of our current liabilities here. We have the total and we have accounts payable. So our total current liabilities less the piece that is accounts payable will equal our accruals. Now let's move over to this side now that we've figured out this part of the puzzle. Our gross fixed assets less accumulated depreciation makes our net fixed assets. So if we add back accumulated depreciation to our net, we'll get our gross. From our total assets, we can get our total current assets because we know the net fixed assets. So we take our total assets minus our net fixed assets, and that will equal our total current assets. And that's because our total current plus our fixed assets will be our total assets. Now we only have one piece left, and that is included in our current assets. Our current assets is a total. Subtract the pieces that we know, and that will give us the piece that we don't know, or cash. So that is 70. We have now completed all of these pieces. Again, we just want to set it up so that we can figure out what formulas go into the totals, and we set our accounting equation to be equal, and then we can fill in those pieces that we're missing. Okay, the last problem here is figuring out the tax of these various amounts. Oh, I'm stalling out. Hold on a second. No. All right, well, I'm going to have to record this last problem on the next recording, so I will do another video that has this final in-class piece with the tax brackets, and it will also have those other Chapter 2 problems.